Hey guys, welcome back to the channel. Last week was the biggest earnings week of the season, and we learned so much about all of the companies that reported. Today specifically, I want to talk about Google and Meta's earnings, as they're both companies that had great earnings in my opinion, but had completely different reactions from the market, with Google selling off and Meta having a crazy 20% spike, and it's the largest ever market capitalization gain in the whole of stock market history in one day.
Wow.
As regular viewers will know, I've been bullish on both of these two companies for years. And whilst I was extremely happy about the gains I got from my Meta investment, I decided to buy around $5,000 of Google stock after the earnings dip, as I think this company is still significantly undervalued. But let's get into the earnings itself. Google beat on both its revenue and earnings per share estimates, so both a top and bottom line beat. Then why the sell-off? Well, the media attributed it towards a tiny miss on its search business ad revenue. And when I say tiny, I mean tiny. It was a few hundred million in a 65.5 billion revenue business. Now, I understand this explanation as there has been a lot of fear in the market that Google's lucrative search business will be massively disrupted by AI.
Is this the end of Google search as we know it?
Search has been about 10 blue links for the last 20 years, and 10 blue links was always a hack. At the end of the day, people just wanted an answer. I'm trying to move you to a paradigm where just like how you would talk to a person, you just directly come and ask you a question. You don't talk to a person by typing in speaking keywords.
With a 13% increase in search revenue year on year and little signs that Google's market share in the search business is declining, I see very little chance of this happening. After all, when it comes to Googling for things that you want to buy, you don't want to have a full-fledged conversation with an AI chatbot.
My darkest thoughts are that humans will eventually be replaced by robots.
You just want to type in a keyword and immediately see things to buy. And Google remains and will remain the best place to do that in my opinion. Sundar Pichai mentioned in the Google earnings call that Gemini, or their AI platform, has been used in search experiences within the last quarter, and it reduced latency, or the time for a search to load, by 40%. So I believe that Google's expertise in AI will actually improve and solidify its dominance in the search market rather than be replaced by alternatives. Ultimately, buying Google shares is a bet that Google can maintain and continue to grow its search business, as 57% of Google's revenues are from search. But it was great to see bright spots in other parts of the business that I believe will drive growth by even more than search over the coming years. And those bright spots were YouTube and cloud. YouTube grew its revenue quarter on quarter by 16%. And this return to stellar growth is no surprise for me, as I think that the business model is one of the best in the world. Not only is YouTube benefiting from the secular shift from linear TV to digital on-demand content, but it's also not having to invest any money into generating content. When you look at Netflix, Disney+, Paramount, and so on, they have to invest billions every year into generating content for their streaming services, whereas YouTube just has to sit back and let its creators create content for it. It doesn't have to invest any money. And whilst doing this, it actually has the largest streaming viewing time out of any streaming service in the US, even Netflix. If you like Netflix's business model, then you'll love YouTube. Last year, YouTube cracked down on people using ad blockers on their sites. It received a lot of controversy online and people threatening to quit YouTube, stop using it. But in reality, there's no alternatives, and it really gives me reminders of Netflix's crackdown on sharing passwords. People said that they would quit, but they ended up using it more, and the companies both made more revenue. Google Cloud posted extremely impressive performance, with its revenue growing 26% year on year. That was higher than both AWS, which only grew 12%, and Azure, which grew at 24%. Now, Google Cloud has long been considered the little brother of the other two and not really a contender in the cloud space. But due to the small size of the business, there is a lot of potential for growth. It's a lot easier to grow a small number than a large number after all. Cloud businesses are highly scalable by nature, and even though Google Cloud doesn't provide that much profit yet, as it continues to scale and add more users, it doesn't really cost Google that much to add them, which means that new customers are pretty much pure profit. That's why AWS generates so much profits for Amazon and allows them to fund growth in other parts of the business. If left unchecked, I'm sure that Google Cloud can grow to levels seen by an Azure or an AWS today. I do think that Azure will win the cloud wars, but there's plenty of room to grow as most businesses are still migrating infrastructure, digital infrastructure to the cloud, and will continue to do so for years to come. There are some weaknesses for Google, and I will be paying close attention to them in 2024. Those are related to the supposed year of efficiency that Google is meant to be going through in 2024, the same as Meta went through in 2023. The company is meant to cut down on some of its bloat, but I don't really see that many signs of it happening. Much has been made of employee cuts and firings at Google, but the employee headcount is still 26,000 more than where it was 2 years ago in Q4 2021. In addition to that, the company has also forecast that it will spend way more on CapEx for AI, data chips, and so on in 2024, so that's something to keep an eye on as well. Looking at some of the financials and valuation metrics for Google, it's sitting in a very sweet spot right now at only 21 forward price to earnings ratio, which is similar to the average S&P 500 company, whilst it's growing at a much higher and faster rate than most of those companies. So in that aspect at least, I think it's undervalued. With regards to its free cash flow yield, remember free cash flow is the amount of cash that effectively goes towards you, the shareholder. It's sitting at around a 4% yield or 2.65% after adjusting for stock-based compensation. The company is continuing to buy large amounts of shares back year over year, but the company still is dealing with having to pay out huge amounts in stock-based compensation, and its efficiency drive and job cuts of a few thousand has not really done that much in limiting the growth in its stock-based compensation paid this quarter. Ultimately, stock-based compensation dilutes you as a shareholder, and you should be hoping that companies limit it as much as possible. It has the opposite effect as share buybacks, which increase your stake in a company and your share of its cash and future cash flows. In contrast with Google's struggles to make its business more efficient, Meta had an absolute blowout quarter to mark its 2023 year of efficiency, where it cut around 22% of its total jobs. Meta absolutely destroyed its revenue and earnings per share expectations, growing its revenue by 25% year on year and its profits by over double compared to Q4 in 2022. And the company was rewarded with the best ever daily gains in market cap in the whole of stock market history. Now, that's what I call a great quarter. Meta managed to reduce its operating costs by 8% compared to Q4 2022. And of course, Wall Street loves this. Zuckerberg as well mentioned in the earnings call that he now has a newfound appreciation for efficiency, and going forwards, I think this is something that is a great sign. Meta pretty much beat all estimates for its daily active people on both Facebook and other apps like Instagram, and I thought that was really impressive. The company has also managed to massively increase the popularity of its Reels on Facebook and Instagram, growing them by around 21% in terms of the number of Reels watched and ads watched on Reels, whilst also increasing the price per ad by 2%. The payoff of its investment in AI ad targeting is really showing this year. Another piece of notable news was Meta announcing its first ever dividend. At $0.5 per share, it's not really a huge amount, but it does represent a big milestone for the company, and the company will be included in a number of different indexes and ETFs, which pretty much guarantees more people buying the company just by virtue of owning dividend ETFs. And those are extremely common. In general, I don't really like it when companies that I own pay a dividend, as it represents them not being able to find any better use of that capital to reinvest back into the business itself. But with Meta slowing down its buybacks so much over the last year, as the share price has shot up by so much, I do think that the company probably just wants to return capital to shareholders without having to invest into its relatively expensive shares. And I don't see that as a necessarily bad thing in this case. Similarly to Google, Meta announced that it would have to invest far more in CapEx for AI chips and data centers this year. AI does not come cheap, and it will represent a material cost to both of the businesses, and it's something to keep an eye on as an investor in 2024. In addition to that, Meta released some interesting information about its Reality Labs segment. Now, Reality Labs and mixed reality are a controversial segment within Meta's business, and many were hyped about it in 2021, 2022, but they've since moved on to AI. But silently in the background, Meta has been doing all right with Reality Labs. The Quest 3 device that got released in October 2023 has driven sales to a new record for its Reality Labs division. It passed 1 billion in sales for the first time and grew its revenue by 40% compared to 2022. There is a big caveat though here, and that's the losses from the Reality Lab division increase yet again by 10% to nearly $4.7 billion in Q4 alone. Now, my Meta investment is predicated on Reality Labs not even being there at all. It is purely based on the social media business. But I do think the Reality Labs bet is a very interesting one. Even if the company completely gives up on Reality Labs entirely, that would be a massive boost to the company. Right now, the company makes around 42 billion in profits in 2023. If you take out the Reality Labs losses of 16 billion in 2023, that would add nearly 50% onto Meta's profit line. And that is a crazy number, and the company would be extremely undervalued even at its current price if it was to do that. Of course, if Reality Labs did well and spiked, then that would be worth even more. Valuation wise, Meta is sitting at only a 23 forward price to earnings ratio, which I don't think is that expensive for a company that is growing at Meta's level, especially when you take into account the Reality Labs division, which if you add their losses onto the profits would make that even lower. Along with the new dividend, Meta also announced an extension of its buyback authorization scheme by $50 billion. The company didn't really buy many shares back net in 2023, but it remains to be seen whether it will return money to shareholders in 2024 via the buyback method. I've previously said that my top 3 picks for 2024 stock-wise are Netflix, Google, and Meta. And we've had a great start to the year with 2 of the companies, Netflix and Meta, absolutely crushing their first earnings of the year. I'm sure it won't take long for Google to catch up with them. I think that this year represents a great opportunity to buy shares in all 3 personally, and I will be continuing to do so. Let me know what you guys think about all of these companies' earnings in the comments below if you disagree or agree with me on any of my points, and I'll see you guys next time. Please leave me a like and subscribe if you enjoyed the video.